Everyone's freaking out. So I posted a video on TikTok a couple days ago, and it was about Fannie Mae removing the 620 minimum FICO requirement from DU, and everybody freaked out, and the video went viral. I mean, viral in my standards. I usually don't get that many views on a video, and the message was consistent between everybody. It's 2008 all over again. They want to take your money. They want to just give money to people who don't have any means of buying a house, and foreclosures are coming, and all of that freaking out and fear. So I decided I wasn't going to do this, but I actually thought I should come up here and help clear up what this is. So that means everybody can get approved for a mortgage now, right? Wrong. Let's hold on before we start looking at homes and trying to buy a house at 400 FICO score. DU typically doesn't just really care about the score itself. It actually runs a full risk analysis. Think of it as like an underwriting robot looking at your whole financial story. The things that DU is still going to look for without the minimum FICO or the 620 that they removed are your credit history and the length you've had credit, any delinquencies, any collections that you have on there. How much credit are you using? Your down payment, aka your loan to value, your DTI, which is debt to income ratio, savings and reserves, how much money do you have saved up, even the property type and the occupancy. So DU actually weighs all these factors in. It's not a pass fail based on a number anymore. So you could have a 610 score, but solid savings, great job, and very low debt. DU might like that. If you have a 680 score, for example, and you're maxed out on your credit cards, no savings at all, and you're constantly behind, DU is going to say, nope, not today. Moral of the story, Fannie Mae still calculates risk on how you're using your credit and everything that's on it. Basically what they did, they just removed a singular requirement as a 620 FICO. FHA goes down to 500 FICO and approves you for a loan. USDA does the same thing. I hope this helps clear any confusion that's going on. No, we're not going back to 2008. No, we're not going to see a housing crash based on this. 2008 was due to a lot of the fraud that was going on back then. Since 2008, now we have different laws set in place. Adjustable rate mortgages have caps on them. They didn't have caps on them before that. They still have caps today. We want to make sure you can afford a home. We want to make sure you can repay that investment. That's why it can get a little bit difficult trying to buy a house when you're not declaring how much money you're making or the money in the bank. It's not in the bank anymore. It's under your mattress. It's a little bit difficult to try to buy a house if you don't have your stuff in order. And that's what we do. This is not anybody just can come in and fill out an application and get approved. There's so much that we look at to make sure that you can actually do this. Now, that's different to say that if you're approved for a higher loan amount, you're not comfortable making the payments. I have clients with me many times that are on paper. They are qualified to get $600,000 or $700,000 loan amount, but they're not comfortable with the payment, so they know to stay around the 400,000. At the end of the day, nobody's putting a gun to your head to do it. You just got to be smart about it as well. And like I always say, happy house hunting. Catch you on the next one.